Right guys, in this next video, what we're going to be exploring is something that we call the business cycle. The business cycle is measuring how output changes over time. So remember, output is the real GDP of the economy. Now the key thing to focus on here is I've drawn two main lines. We've got this one, which is measuring something that we call the trend rate of growth. Now this is potential economic growth. Over time, the economy's factors of production will improve and increase. And the logic will be this will dictate roughly, on average, how much the economy should grow by. So look at this, as I move outwards along the line, the PPF is moving outwards, and that will mean here in the future, the potential output, the PPF or the LRAS curve, is a lot further out than it was here. Now, if we were operating on this line, we have something that we call economic stability. We've got stable, consistent rates of economic growth. And the problem is economies don't tend to grow like this. Economies tend to move up and down like this. Okay, so here we are measuring actual growth in the economy. In other words, how GDP or output tends to change over time. Now it will follow the trend roughly, but it doesn't mean that every single year we're going to be achieving trend rates of economic growth. We have a period of time when the economy outperforms the trend rate of growth. We're above the trend rate, so economic growth is higher than maybe what it should be. Here, economic growth might be negative and the economy is below where it wants to be. Okay, so the logic is economies will follow roughly the trend rate, but it will not follow it perfectly. The economy goes through a cycle. The logic would be, let's imagine we start off here. Here we've got really high rates of economic growth. We're moving into what we call an economic boom. So here we've got lots and lots of high patchwork economic growth. Confidence is high, spending's high, incomes are growing, consumption, investment are really high. But then what will happen is the economy will peak. This is the highest economic growth that we've got on this diagram. Then what will happen is the economy will move into a downturn. So what we'll do in the second year, we'll look at potential causes of this. But normally there'll be something that triggers a drop in spending across the economy, which means output starts to fall. Now if output starts to fall for at least 2 consecutive 3-month periods, the economy will move into something that we call a recession, when we have negative economic growth. And again, this will bottom out as something that we call a slump or a trough, in other words, that's the worst the economy will get to. Now there is also something that's worth noting here. We might be having one of these soon. We have something we call an economic depression. Now a recession is when GDP falls for at least a 6-month period. We had one of these last in 2008. But if we have a really severe recession, we call it a depression. Now a depression could be where GDP falls for a prolonged period of time. Unemployment might start to exceed 10%. That would be called an economic depression. But then what starts to happen is, after the slump, the economy starts to recover, where GDP growth again starts to increase and the economy starts to move back up towards trend rates of economic growth. Now there's one easiest way of thinking about the business cycle and what can cause it to happen. In the build-up to the 2008 financial crash, the economy was booming in the noughties. So before 2008, we had high economic growth, we had wage rates increasing, and people started to buy more property. And this raised the demand for property, and that meant that house prices started to grow. People became more wealthier, people started borrowing more money, spending more, and the economy boomed. And then for reasons I won't really go into in this video, there was suddenly a drop in demand for houses. Things went wrong in the housing market, property prices fell, and people became less confident, and the economy nosedived into a recession. A couple of years later, recovery starts to happen again, and the economy started to pick up. Right, now what I've also included here is something that we call a positive output gap and something that we call a negative output gap. And I want to think about what is happening here and what is happening here. Right, so first things first, you've got here a positive output gap. Remember, a positive output gap is when we're operating above the trend rate of economic growth. Remember, trend rate is measuring the average increase in the potential output of the economy. So the logic will be that when we operate above the trend rate of economic growth, actual output is actually exceeding potential output. And this looks really, really strange. Look at this. The actual output of the economy is beyond the PPF curve. We're producing more than what we should be physically able to produce in the economy. We can show it for ADAS. I've got here a classical LRAS. The actual output is beyond the potential. Now, how we can do this for a very, very short period of time is by getting people to work lots and lots of overtime. So people really are working a lot more hours than what they would like to. Firms are working over capacity. Now, the logic is because you've got such high demand in the economy, businesses have got more demand than what they can physically produce. So the only way of producing more is to get existing workers to work overtime, to work beyond the capacity of the economy. Now the problem is this is not sustainable. There are some very good things about being here though. Remember, we've got really, really high rates of GDP growth, and that will mean that wage rates are increasing massively. What it will also mean that when we've got a positive output gap, the economy will have very, very low levels of unemployment. Due to high demand for output, it means that businesses are gobbling up workers left, right and centre. Anyone that wants a job will be getting jobs. Now, because you've got such a growth in demand for wages, what you will also then get is a growth in wage rates. The high demand for labour will bid up wage rates, which allows people to spend more and more and more. And in many ways, that will add to businesses' problem as people start to buy more and more goods and services. Now, because unemployment is so low, it could mean that lots of people in the economy are actually overemployed. So the logic will be here, you've got people working more hours than what they want to. It could even be that people have been promoted into more senior roles without really having the skills or expertise for that role. So people are working beyond their skill level, or they're working more hours than what they would like to in the economy. Now, because there's big growth in demand, AD moving outwards, resources becoming extremely scarce, it means the economy will start to have really, really high rates of inflation. What will happen is the high scarcity, that low availability of workers, will mean that price levels get bid up really, really high. Now, because price levels start to grow, workers start to demand a growth in wage rates. And what that will do, it will add to business costs, which means businesses again got to raise prices. So what we've got here is something we call a wage price spiral. As demand for labour starts to increase, wage rates start to grow, and that means that firms need to raise prices to remain profitable, which means that workers will again want more wages, and that will again add to business cost. Price levels go up again, so workers, to protect real incomes, want to see wages increase even further. Now, due to the growth in demand and high demand for property, you'll see a growth in asset prices, so house prices will shoot through the roof. So people start to build up more wealth. As businesses become more profitable, shares they own will also start to become more profitable. You could even argue it's really good for the government, all this. More tax revenue from more profits, from higher incomes and more people working will bring in more tax revenue. You've also got fewer benefit payments that need to be made. So the government should hopefully be able to reduce national debt. Now, when you think about it then, low unemployment sounds like a good thing. Yeah, it's pretty good. Overemployment, I'm not so sure that's a great thing. People being almost bullied into working more hours than what is, safe, or in jobs beyond their skill levels. High inflation, never a good thing. Asset prices growing, well, that could be a good thing. It's good for homeowners like me, but it wouldn't be very good for people looking to buy their first property. They might not be able to afford to buy anymore. This is good for the government, but overall, look at this one. In Britain, we've got a high marginal propensity to import. Due to incomes increasing, more of us will start to buy more imports. So it could worsen the economy's trade position. So bin up here looks like a really, really good thing. And there are some good things like low unemployment, growing wages, but there are some big problems. We've got more imports coming in. High inflation seems to be a big problem. Right, now let's move away now onto a negative output gap. Now a negative output gap, and this should be a bit more obvious really, this occurs when actual output is below potential output. The economy is operating below its potential output or its trend rate of economic growth. What it means here is we have spare capacity. So with a classical LRAS, the economy is below its potential. With a Keynesian LRAS, again, we're below our potential output. Now, this is really, really bad, because when you've got spare capacity in the economy, it means you've got lots of unemployed people. You've got more underemployment, and because you've got an excess supply of labour, you might find that wage rates start to fall, people become poorer. It could mean that more people find themselves in debt. They might suddenly not be able to keep up with mortgage repayments and have their house taken off them, can't pay the landlord the rent and get evicted from their property. Now, because you've then got high unemployment, you've got poor animal spirits, you've got low confidence in the economy, spending starts to fall. Now, when you've got spare capacity, firms start to struggle to sell output. Well, that could mean they start to lower price levels. So we might start to have deflation taking place in the economy. Now, when you have deflation, remember people will start to, well, hang on, if price levels are falling, I'll not buy now, I'll wait a couple of weeks. And that could make that recession, that negative output gap, become even worse. Asset prices start to fall. So the logic will now be, because you've got falling demand for property because of high unemployment, house prices start to fall, so people's wealth starts to go down. Further to that, because firms are now less profitable, making staff redundant, got falling demand for their output, their share prices start to fall. But that means that people that own them companies will see their wealth again start to fall. And it's bad for the government, because here, tax revenue will be falling. If less people are working, more people are unemployed, they're not paying income tax. Due to lower profits from businesses, there's less business taxes coming in, less spending, so that's VAT being generated. But also, because you've got unemployment, you've got more benefits that need to be paid out to people as well. So more things like job seekers allowance. One potential good thing is that because people are poorer, they will buy fewer imports. That could lead to an improvement in trade performance. So overall, what we would say is that it's bad if you are down here. Now, just to go back to the business cycle overall then, just to wrap up this video. Ideally, we want the economy to operate on this. This is economic stability. You want the economy to grow steady over time. You tend to find that when you're in a peak on the business cycle, you're going to have really, really high inflation. Really, really high demand for output will force up price levels to unsustainable levels. The economy will need to crash. When the economy moves into recession and gets towards the slump, you tend to have really, really high unemployment. So the logic is, up here looks good, but it's not. It's unsustainable. It's going to create lots and lots of inflation. Down here is terrible. It will create lots and lots of unemployment. So the job of the macroeconomist often is to keep the economy as close to that trend rate as possible by eliminating both positive and negative output gaps. Thank you very much.